Hi everyone, welcome to our DAT IQ Weekly Market Update. This is our update for August 27, episode 306. I'm Dean Croak, market analyst here at DAT Freight and Analytics, along with co-host Chad Kennedy and special guest owner-operator Corey Larson. Good morning, everyone.
Morning.
Good morning.
Good. How's things out in the Midwest, Corey?
Warm and sticky this last week. So
yeah,
sounds like Florida.
That's going to clear up this week after today. It's supposed to get some big storms this afternoon. So
yeah. I spent the week in Canada, and it was interesting, Corey. They've a lot of them were saying that after it looks like an early fall because the leaves were changing color much earlier than they expected, which is normally something you see when it's been a dry summer. But they've had an incredibly wet summer. It's been quite the opposite. So no one can quite figure out why all the leaves are changing color so quickly. But fall is that's for sure.
I've had the same thing here. I mean, I've spent most of the summer with standing water on flat ground, and not having to use sprinklers or irrigation. But I have, in the last couple of weeks, I've got leaves falling every day. Every time I mow, there's more leaves falling already.
Yeah. All right. How's things in Florida, Chad?
Things are good. Definitely don't have any fall weather down here. No leaves turning yet. We'll probably come around January.
Right.
But yeah, things are good.
All right. Well, lots to chat about. I've just spent the last 10 days on the road, 2,500 miles, a couple of truck shows in Canada. There's lots to talk about in owner-operator world. So we're looking forward to digging into this more with Corey. Corey, for those new to the show and they don't know you, haven't seen you on our previous shows, tell us a little bit more about what you do and where you operate.
I am a owner-operator, single owner-operator. I have my own authority. I work mostly in the Midwest, the Minneapolis area, 5-state, 6-state area up here. And I also run a lot down to the Southeast, down to Florida and Georgia. I had a home down there for several years in the past as well. So,
right. All right. Well, we'll bring you back towards the end of the show and dig into some of the hot topics and some of the things you're seeing. For those new to the show, again, we're here 10 a.m. Eastern, 7 a.m. Pacific every week. We're talking about the freight market. Let's start off with some of the key trends we're watching in the market. I'll dig into this a little bit later, but spot rates are flat to down slightly. We're seeing a little bit of softness in the market still, but there's certainly signs that some lanes are improving. The Canadian rail strike last week was a 4-day event. That did move the needle on some lanes in particular, especially long-haul lanes. LoadLink, our sister company in Canada, reported a 30% increase in load volume. Cross-border volumes increased, but most of the increases in freight volume were long-haul lanes within Canada, predominantly handled by rail. No surprise there. Prime example, Toronto to Winnipeg. Load-to-truck ratio on that lane was 3.04. Last week, it was under 1 at 0.72 trucks per load. On that lane, Toronto to Winnipeg, the average rate's been about $3,500. Last week, people were offering $8,500 for any available truck. Toronto to Calgary climbed to $10,000, from an average of $6,000 per load last week. There was a little bit of imbalance on some of the cross-border lanes. Toronto to Chicago, rates up 11 cents a mile. Volumes are up about 30% week over week, and about the same sort of volatility in the opposite direction. There is some impact, I think, on the West Coast. Paul Brashear, a guest of the show recently, publishes the ITS Port Rail Ramp Index report. You can subscribe to that at ITS Logistics. They've moved the West Coast region to severe in terms of concern for inland congestion and dray impact. Inland ramps in particular have an elevated concern due to the potential rail strike there. West Coast is seeing an increase in volume. A lot of shippers have been rerouting to avoid the strike in Canada and the labour disruptions on the East Coast. Excuse me. Paul also indicates the chassis pools, especially Long Beach, Los Angeles, are starting to see signs of stress. So I think even though the strike is over, there is going to be some lingering disruptions in the market this week, maybe into next week. The other data point popped out last week, residential construction. Housing starts fell 6.8% in July, 16% year-over-year decrease. That's the slowest pace of starts in roughly 4 years. Of course, Brake Check Week is underway this week, ahead of what is end of month and end of quarter, and of course, Labor Day next week. I'm expecting a little bit of market volatility this week and capacity tightness leading into next week. All of this we'll cover in this week's market update at dat.com/market update, where we're talking about produce, CVS Brake Safety Week, some shifts in capacity, and other things related to flatbed and reefer truckers. So let's dive into our weekly report. The load to truck ratio in dry van load post volumes were about 9% lower last year. In dry van, they're sitting about 22% behind this time last year. But I'm expecting all of this to change this week, heading into the end of month and the short week next week. Certainly could be a calm before the storm in the market. And I think that's being reflected in some of our short-term forecasts that we'll cover later. Capacity levels mostly flat, slight decrease in the load to truck ratio to 3.40. That's about 2.2% above the long-term load to truck ratio for this time of the year. In the refrigerated market, load postings down 8% last week, sitting about 34% lower than this time last year. So a lot of market softness in the temp controlled area. Produce volumes, last week they recovered a little bit, still about 4% lower than last year. That's impacting reefer load posts. Carrier equipment posts 4% lower. Load to truck ratio down to 5.68 last week. And in flatbed, load post volumes also down 5%. Carrier equipment posts, though, mostly flat. Last week's load to truck ratio on flatbed down 4% to 9.96 loads per truck. In the year-over-year look at spot rates, as you can see from the chart there, the black line, dry van line haul rates continue to soften slightly following last week's penny per mile decrease to just over $1.61, $61 per mile. It's about 3 cents a mile higher than last year if you track that black line across to the right. According to our DAT top 50 lanes, the spot rates were flat at $1.99. So that's based on the volume of loads moved on our top 50 lanes. That's 38 cents a mile higher than the national average of 161. But a lot of seasonality there in terms of how it's tracking with last year. And in refrigerated, reefer line haul rates have remained flat for almost the fourth week. Heading into the fifth week, they're still showing signs of flatness. Loads moved compared to this time last year in the refrigerated market are down 1%. At $1.97, reefer spot rates remained almost identical to this time last year, and they're about 2 cents a mile lower than the 3-month trailing average in that category. And lastly, in flatbed, the national volume of loads moved was up 4% last week and 4% compared to this time last year, while flatbed line haul rates remain flat. Remember, folks, these are line haul rates excluding fuel. They remain flat at $1.97 a mile last week and almost 5 cents a mile higher than last year. Having a look at our short-term forecasts, for those new to the show, this is our rolling 7-day weighted average of historical rates. That's the blue line. These are loads moved over 550 miles. They're line haul only. Rate casters in green, that's in all of our products. The red line is our short-term model. It more heavily weights data seen more recently, whereas the green line rate cast weights more seasonally affected data. And the yellow and grey are blends of the two in varying degrees and mixtures. We're seeing some model disagreement again this week. This is about the fourth time we've said this, where we've seen the short-term market be a little bit more pessimistic, I think, than where we're at. There is a steady, consistent exodus of carriers from the industry. In the spot market, we're seeing about 8,000 revocations a month, but oddly enough, we're seeing about 8,000 new entrants a month also. So there's not a lot of change in net capacity over June and July. There is a slight trickle of carriers going out when you look at the net, but there's a steady state of survivors in this industry right now that are able to operate at current market rates. I think that's going to keep rates fairly flat to certainly soft, but flat for the rest of the year, especially as demand moves sideways. So I think the net of this is we'll see rates fairly flat until we start to get into some of the seasonality leading into things like Halloween, Thanksgiving. Imports are certainly going to peak in August by all accounts. As Chad said earlier in the show, consumers are getting earlier and earlier when it comes to shopping. So we're seeing loads moving a little bit earlier. Peak season has certainly arrived a little bit earlier on the import front than we would normally expect to see. ATA also just reported for-hire truckload tonnage up 0.3%, so up slightly. So we're seeing a little bit more volume move compared to this time last year against the backdrop of carriers leaving. That's keeping rates flat to slightly up. Similar story in the refrigerated market. It's heading into its season in the lead up to Thanksgiving. So we're starting to see the tail end of that movement of things like fresh turkeys. They generally move 3 to 4 weeks out from Thanksgiving. So our 35-day forecast is starting to reach that time band right now. That's why I think we're seeing the green line in rate casts reflect where I think rates are going to be for the next 35 days, which is relatively flat to maybe up slightly, a penny or so. They're forecasting them to be up 3 cents a mile out to the end of September. And in flatbed, again, lots of strong model agreement. They're reaching the end of that phase where rates decrease from June. Rates typically decrease in the order of 30 cents a mile from June to the end of September. We're out into the end of that time band right now. And as you can see there, all of the models are in agreement that rates will start to pick up slightly then. Okay, Chad, what are you seeing in the contract rate market?
Yeah, so I like to point out that everything that Dean just covered is from a broker to a carrier perspective, primarily from spot rates and also from our load board activity. What I'll review here is the shipper procurement mix. So in blue here, we have contract rate mix and in yellow spot mix. So this is for dry van, and since we're going back to 2016 here. Recently, we see some trend up. So June, July, and August have all trended up slightly with increased spot mix currently at 27% and 73% contract. And then we also watch alongside of this, the spot premium ratio. This is the premium for spot rates compared to contract rates. So this is a nice signal that, we're looking for this to cross zero, where spot rates go above contract rates. So this is a function of spot rates going up slightly or remaining flat, and contract rates continuing to come down just a little bit. So that's what we're seeing on this side. You can see there in the black trend line, we've been in this rate trough for some time, the longest extended period of time that we've seen in history. So we'll go on over to Temp Control as well. We're seeing similar trends there in Temp Control. And I'll just add from a shipper perspective for both of these, for dry van and Temp Control, these are primarily limited to live loads, spot procurement that is. So typically, and just speaking in general terms, typically it's more difficult to get a drop trailer assets on a spot load. So that limits a lot of that shippers being able to take advantage of the spot market in this soft market. And then we'll move on to flatbed as we see an increased utilization of spot shipments. This is typically because of the short duration of these lanes or seasonality in these lanes. We're seeing some pressure downward on the spot premium ratio, down to 10%. So that's not great news for flatbed haulers and decent news for flatbed shippers. That's a wrap on the shipper side.
All right, thanks, Chad. Very interesting. So let's bring Corey back in. We're getting to the fun part of the show. Corey, as an owner-operator, independent contractor, how are you finding this somewhat soft freight market?
It's been pretty slow for the last year or so. But I've started to notice the numbers, the volume ticking up a little bit. I have a couple of searches that are set standard, so I look at them every day. And you can see the amount of available loads in the morning is always, it's higher now. Minnesota's been a typically good market for freight, but it's been really slow. A lot of people go over to Wisconsin and grab that, which is watering that market down, but it's coming back. I think the loads are there, the volume's there. You just have to wait a little longer. It takes a little more effort to find, in my opinion.
It's interesting. I just pulled up some data on loads moved as opposed to loads posted, which you referenced. Loads posted or loads moved are up about 8% year over year. They're up 18% in the last month. So that kind of supports what you're seeing with that increased activity. Rates, though, are fairly flat to down slightly. They're down a penny per mile compared to this time last year. So there is more volume moving. When you look at Minnesota, do you mainly look at the Minneapolis freight market as the larger one?
Well, I'm kind of where I'm located. I'm west of Minneapolis. I'm closer to the St. Cloud market. I'm kind of right in the middle of them.
Yep.
And I've got customers kind of all over the state. It's not a very, you're only a couple 100 miles from Duluth or Fargo or, so you can kind of go everywhere. So I kind of look at the whole thing because I'll run anywhere. I can take back roads to get there quickly and avoid the Minneapolis traffic if I have to.
Yeah. And Corey, you're running dry van?
Dry van, yes.
Yep.
Yeah.
Yep. What types of freight do you run typically?
I mean, I've been in this market for over 30 years, so I got some pretty good connections with some of the larger shippers, whether it's, types of stuff for manufacturing products, whether, the John Deere's, the Cases, the Polaris are all based up out of this area. So there's a lot of that kind of stuff, a lot of beverages. There's some alcohol moves that some people can't move or don't know the qualifications for that. So there's a
And
big
you're-
brewer 20 miles from me. So
Okay. And you're contracted directly with them, or do you run those?
No. I run strictly spot, but I get phone calls from them when somebody falls off their load and they need it covered.
Right.
You know, I like to run that 3 o'clock shuffle, as we used to call it, or that type of thing. You know, it's just what I do. So.
Right. You know, Corey, I just split up the Minnesota market. Load volumes are up. These are loads moved up 10% in Minneapolis, but rates are flat, averaging $1.71 excluding fuel. And in St. Cloud, which is interesting, it's about the same number of loads moved. Rates are up 1.2%, but rates are down 6 cents a mile in St. Cloud. So even though volumes are up in St. Cloud, rates are down. They're up 4 cents a mile in the last week to $1.71. So when you net that out, both markets have got about the same average outbound excluding fuel. Top lanes include Chicago and Kansas City. On the Chicago lane, that would be considered a regional lane. Would it be a same day? Could you do a round trip in a day to Chicago or not, Corey?
Not quite a round trip. And that's kind of the market I run. Is I'll run from Minnesota down towards southern Wisconsin, Milwaukee, Chicago area, and then pull back out of there coming back. So yeah, you can't quite get there. I mean, it's close, but
that lane in particular is up 10% year over year. Rates are down 5 cents a mile to $1.61. So while the average out of St. Cloud, Minnesota is averaging $1.71 excluding fuel, it's 10 cents a mile lower on that lane. So that would be a highly competitive, high volume lane for carriers too, like you, I guess.
Yeah, and you see the loads. I mean, from what I see, at the rates, posted rates, if you want to go that route, whether it's on the click and goes or the load boards, they are lower, and they get taken quickly. But if you just post and wait, the calls, you get the phone calls because people fall off, what have you. And I'm not having an issue with rates. I run for mine are substantially higher than that. But they're comparing them to 5 years ago. It's around the same rates I was running for back then. I mean, you throw the 2021 numbers out and it just takes a while longer.
Yeah. If I go back to October of 2019, go September, $1.71. There you go. On this exact time in 2019, it was $1.73. It peaked in October to 207. So there's some seasonality on that lane. I think you alluded to that earlier. But yeah, they are exactly the same as this time in 2019, which of course was a soft freight market for all of us.
Right. Yeah, absolutely. And they're going to peak here because the weather's turning. You know,
right.
People don't want to come up here, myself included, when winter comes. But that's a lifetime of being in Minnesota. So
yeah. Hey, you mentioned qualifications to haul certain types of alcohol or other substances. What were you alluding to there?
Well, when you cross state lines, some states require permits, alcohol permits. You know, whether it's Kentucky, Ohio, whether you're picking up there, that type of thing.
Gotcha.
This particular load that I'm going to do this afternoon is for them, and it's just going to Wisconsin, but they thought you needed which you don't need alcohol permit for that between Minnesota and Wisconsin. But there's a lot of people that don't realize the restrictions.
Makes sense. So Corey, you've been doing this a while. I'm curious, for a new driver coming into the industry, what type of advice would you give them?
Know your cost if you're doing it for yourself, if you're a company driver, or if you're not a company driver, the main thing is just do what you say you're going to do, show up on time, be respectful. There's a lot of guys, I get so many comments when I show up places. I'm not afraid to get in the back of a truck and just stand there and talk to the guy that's loading, or, move a pallet around if you need to, or help out. I don't need to charge extra for that. Some things, of course, but it's just the industry's gotten, guys don't get out of their trucks. They just back in and they sit in the truck and wait, which is fine. COVID kind of made people do that, but a lot of shippers, they appreciate it when a guy gets out and is sociable with them, and they know that they care about the freight, what have you.
Right.
Basically, I mean, we're picking stuff up and we're dropping it off, but you can take care of your customer in between those things too.
Sure. So it's on that relationship side.
Right.
It is. And the AI part and the click and goes have gotten rid of that, whether it's the brokers or not, but it's still there, at least in my opinion, and people appreciate that.
Yeah. What advice would you give to a shipper who's trying to improve their reputation in the market as a shipper of choice?
Communication.
Mm-hmm.
That's the biggest thing. Detention's a big hot spot for everybody. And there's certain shippers or whatever that I won't deal with just because I'm not going to deal with that, because you're never going to get detention pay. It's a big battle. But just sitting there wasting time all day long is frustrating. And when a driver goes in and says, "Hey, is this going to take an hour?" And they say, "Yeah, it shouldn't be no problem," and you're there 4 hours later and haven't started loading you. If they would tell you that, you would know, especially in the days of ELD, where we can go off the clock and not ruin our clock, or you plan ahead. You're going to pick up certain places that I'm going to be there all day, which is okay if I know I'm planning on a whole day's work. And that falls along with the rates you're charging too. You're charging for time.
Yeah,
it's more important than the actual mileage rate.
Right.
That transparency is key. Huh?
Yeah, just have people, and I get it that a lot of shippers, they get abused by the drivers that come in there. They're demanding things and all this stuff, but it's frustrating for everybody. So just communication from everybody is a big thing.
Yeah, that makes sense.
Corey, it's interesting you talk about the loading aspect and getting in the back and helping. Do you get the opportunity to look what's in the trailer so you know how it's going to handle, how it's loaded, how it's secured, or do you find most of the time you're not allowed to look in the back of the trailer when it's loaded?
There's a lot of people that won't let you do that, but then again, if you know it's the commodity, I'm going to make sure I see what's in there, or look at it when you're loaded and make sure. And you can, you're in control of that ship, as they say. So if you don't think it's going to make it to the point, you better, at least when it's me doing it, because my insurance is the one that's on the hook. I'm not just the driver. I'm the owner of the company and the one that pays the bills. So if something gets damaged, it's gonna fall on me. Especially what I do a lot of beverage loads too. So they're usually pretty good. But then again, you want to bring it up ahead of time too to the guy on the dock and say, "Hey, start loading it a certain way, so your weights are going to be good, what have you."
You talked about click and go. Can you kind of talk through, for those that are sort of new to DAT's load board technology and products, what a typical day looks like for you in terms of using the technology?
My typical day for finding loads, I primarily use DAT. That's the click and goes. There's like the brokers that have their own load boards, whether it's CH Robinson's or TQL's or what have you. I'll look at their loads and I'll just throw bids on. They're typically looking for the cheapest rate, and that's where the guys are grabbing the loads, and they're just disappearing off the board immediately in today's market. I'll throw a bid on them, and then I go to the load board to DAT, and I'm calling on loads that are on there to find my load. And it's usually the brokers. A lot of times it's the brokers that don't have a clickable, load board for them. They're the ones that are going to get the call, and I'm going to get my best rates with them because they're talking to you. You're weeding each other both out, what have you. So I spend a lot of time looking for loads, and I plan my areas where I'm going to go, like for the week, or maybe it's just a couple days. I'm a little blessed in that I can pick and choose where I go. I've controlled my costs over the years, so I don't have to be in such a hurry to grab something. I don't have a problem hanging out for the afternoon and go get something to eat at a cafe or something, and looking and waiting for tomorrow too. So.
So is there a time of day that you think is always the sweet spot for finding those best loads?
Usually in the earlier morning, like between 8 and 9, because that's a chance that somebody fell off a load and they got to get that moved now, especially if it's got to deliver. If shorter mileage run, they wanted it as a direct, delivering the same day. Or it's, the later in the afternoon when a lot of guys and gals are out of, their clocks are winding down, and I might have a fresh clock or something like that. So it's usually the beginning of the day or the end of the day. There's the best times. The middle of the day, there ain't much there, The end of the afternoon is also when the shipper says, "Hey, we want to get that out of here today," or, like this week, end of the month. So it's probably going to be pretty good towards the end of the week here, Wednesday, going into a holiday as well.
Yeah. Corey, when you're bidding on a load, can you walk us through how you think about what price to put on a load?
I think for me is I've got years of history on lanes. The time of day matters, so I know what I can shoot for. I look at the the market conditions on DAT's stuff and the rate, the averages. So I know what they're running on that. I'm never going to run for the posted rates. I'm never going to run for the averages. I'm always going to shoot higher because I believe I'm better than average. So,
Right.
But it gives me a gauge of where to go and what other brokers might be dealing with and the calls they're getting. So it's, and then I figure in my time. That's the biggest thing for me. If I'm going to be, I got a rate that I want to make per day for the truck that it's running, and if it's going to take me overnight and I got to deliver it tomorrow, then I'm going to charge at least that rate. And other things that figure into there too. If you got a tailgate freight, out at a farmer's field, with the pallet jack that they're going to provide, then you might charge a little bit extra for that additional stops. But you're seeing a lot of that now. At least I am. A lot of multi-stop loads, so you charge a little premium for that as well.
Sure.
It's an interesting concept, Corey. I talk about a lot in particular in the post-ELD environment is revenue per truck day, as opposed to just the rate per mile. Because I'm a firm believer that a rate per mile could be half what you need if it's a 2-day haul on a 600-mile load. You probably need 1,200 miles over a period of 2 days to meet your target if you're just talking about rate per mile. Do you have a target range where you kind of look for in revenue per truck day, because you've got fixed costs no matter whether you run or not? Do you sort of have a target in mind for each day?
It depends on what I'm doing. If I'm staying, around the what I call the 5-state area, which is, the upper Midwest, it's usually going to be around that $1,000 a day mark. Generally, I shoot a little higher than that.
Yeah.
But if it's just a load running, I can run locally within the state or something, or just across one of the borders, and I'm okay making $800 a day. But that's because I don't have a high cost. I don't have truck payments.
Right.
So my insurance, I've been around so long that my insurance is not the astronomical numbers that
Right.
a lot of people are forced to pay, and especially in the first couple of years of authority. I've had mine a long time, so I don't have to, but I'm out here to make money too. So I'm gonna, I'm making a profit. I'm not looking to break even.
Yeah. Do you have go-to brokers that you always work with? You have a great relationship over the years, or are you mostly in this soft market working with new brokers every day?
I have a lot of the same ones that I've worked with for a lot. I'm constantly adding new ones. I don't have a problem with them. I vet them and check credit and all that stuff. You have to be mindful of that in this environment, but with all the fraud and what have you. But I have some I get phone calls or emails from these guys that I've worked with for years. My career, half of my career was spent as managing distribution centers and negotiating rates and running large shippers. So I've got contacts on all sides of that. I'm in Minnesota, so C.H. Robinson's based here, so I work with them quite a bit. But it's personal people, the ones that are still left. A lot have moved on or been laid off, but yeah, so it's a mix. It's a mix.
You mentioned vetting new brokers. How do you go about doing that?
Well, I check the reviews and their insurance and all that on, whether it's safer. I run their credit. I do that for any load, even brokers that I do business with all the time. Every time I haul a load, I run the credit because things change in an instant, as we've seen. So it's mainly that. I look at reviews. I look at a lot of the DAT reviews. I look on Google reviews, So.
Wow. And what do you have a feel for what percent don't pass your test?
If their credit's good, most of them are pretty good. I don't, there's certain ones that, I got a do not use list, but that's because they've done something in the past, whether they, give you a load, then all of a sudden they call and, oh, that load canceled. Well, no, it didn't. You found somebody cheaper, and, it's pretty obvious. So there's certain brokers or shippers that I won't deal with just because I don't want to deal with the hassle. But.
Right. Makes sense.
Yeah.
All right. Well, this is we're kind of bumping up on the end of time here, Corey. If people wanted to contact you, what would be the best way for them to do that?
Send me an email if you want. I've got cheelob@gmail.com is the one I have to use, mainly because we don't want to change anything in today's environment.
Right.
The domain company. It's a company domain. I can't use it until the fraud gets cured up. But that's the best way, is send an email.
Okay, we might put that in the bottom of the comment section here for everyone to grab. All right, well, thank you. Don't forget, the Freight Bond podcast is out. Professor Kaplis is talking to Josh Brogan from the Kearney State Logistics Report. DATCon's coming up October the 22nd to 24th. Register at dat.com/DATCon. Use update 100 code. We won't have a show next week due to the Labor Day long weekend. We'll be back on the air on September 10. Make sure you subscribe to the alerts for the live show and to the channel. And with that, another show is in the books. Be safe, be nice to everyone, and we'll see you back here again on September the 10th.